Just the other day, we had the biggest IPO of 2025. CoreWeave decided to go public on the NASDAQ and was met with a pretty lackluster reception. Their IPO price was set at $40, which is actually down from the original IPO price that management had planned. They lowered it because they didn't think there was going to be much excitement around it. And they were right. The stock closed at exactly $40 a share, showing exactly 0% gains. In fact, there were times when you could buy the stock below the IPO price, and that's pretty uncommon for an exciting IPO. Typically, as soon as a new IPO starts trading, it'll jump in price, so the first trade might be above the IPO price because people are so excited about it that you might not be able to get in at the IPO price. With CoreWeave, that was no problem. You could easily get in at or below the IPO price. So let's find out what CoreWeave does, why their IPO was so lackluster, and if it's a buy today. So according to CoreWeave's website, they call themselves an AI hyperscaler. They provide a cloud platform made up of infrastructure and software that's supposed to power the next wave of AI according to their site. Basically, they are selling access to supercomputers for some of the largest companies in the world to train AI models or do whatever types of accelerated computing tasks they need to related to AI. CoreWeave is what's known as a neo-cloud company. So when we think of cloud computing, the biggest players in the space are those legacy hyperscalers. These are things like Amazon with their Amazon Web Services, Microsoft with Azure, and Google with Google Cloud. You have some up-and-coming players like Salesforce and Oracle, but those are kind of the main three players in the space. Neoclouds, on the other hand, are similar but a bit different. So they're focused on offering GPU-backed servers, whereas typical cloud computing might be CPU-based, as well as GPU-based. The other interesting aspect about a neocloud company as opposed to a traditional hyperscaler is that they can often be more affordable than the hyperscalers. This makes me think of a company called DigitalOcean, which I've analyzed before. They are a type of neocloud company, so they offer cloud infrastructure to small and medium businesses who can't always pay the high price tags of Amazon Web Services. So this is definitely not a new business model. Companies like this have been around for a while, but they're definitely gaining in popularity as AI takes off. We can see from this chart how a neocloud can often give you great performance for a much lower cost. In fact, less than half of the cost sometimes. So that definitely explains how CoreWeave is seeing triple-digit revenue growth, 500% revenue growth, in fact. They're able to offer access to high-powered NVIDIA-based compute at a lower cost than the hyperscalers. And this is a time when compute is like gold. So if you have access to NVIDIA-based computers and you're willing to sell that at a reasonable price, companies are just going to eat that up. Comparing CoreWeave to a similar competitor, Nebius, which also went public recently, it's like night and day. CoreWeave has much more infrastructure than Nebius. We see CoreWeave with 250,000 GPUs, Nebius looking to scale to 60,000 GPUs, only about a fifth of what CoreWeave is working with. So this all sounds pretty good, and actually it got better when I went over to my spreadsheet. This is my growth stock spreadsheet where I rate stocks on 4 factors, and those factors are gross margins, annualized revenue, which shows how much market share the company has captured, price to annualized sales, which shows valuation, and quarterly year-over-year revenue growth. I aggregate those 4 metrics. I have a formula that gives me a score, and then I can compare that company with other companies I'm looking at. The interesting thing about CoreWeave, it is the highest scoring stock on my spreadsheet right now with a score of 16.8 compared to my average score of 12.5. So my spreadsheet is telling me that this is a screaming buy, but there's more to look at than just those 4 factors. So yes, those 4 factors look great. We have solid gross margins of 76%. That's comparable to a software company, maybe a low margin software company. We have annualized sales of nearly $3 billion. So this is starting to look like a mature company, even though it's a new IPO. We have a price to annualized sales of just 6, which is on the lower end, especially when you consider growth of 544% year over year. So this is a rapidly growing company trading at what looks like a reasonable valuation, but that's not the end of the story. So CoreWeave definitely had a very lackluster IPO, and there's a reason for that. Let me give you all of the dirt on CoreWeave because unfortunately there's a lot. So let's start with this. Debt to equity of 800%. This is long-term debt compared to their overall equity. So equity is assets minus liabilities. So this is a very, very highly leveraged company. Just last year, they secured an additional $7.5 billion in debt. That's pretty big considering that this is a $19 billion company. The first question most investors might ask is, why did they take on so much debt? Well, it's important to note that this is not a software company. Even though they have those software margins, it is still very much a hardware company. What they do is basically reselling. So they buy NVIDIA GPUs, they build out these data centers, and then they rent out access to those GPUs and data centers. So as you can imagine, buying all those GPUs and building all those data centers is not very cheap, so they need money to do that. However, the company claims that their debt is actually their fuel for their revenue, which is an interesting take, right? They say the debt is the engine, it's the fuel for the company. We go out, we find great contracts with great counterparties that need massive scale computing to drive their business, and then we go ahead and we go back to our syndicate of lenders, and they give us the debt to stand up the clusters that will deliver revenue to the company. And that's definitely an interesting business model, right? It makes me wonder what kind of moat this company has. I mean, what's stopping another company from getting a bunch of money on debt and building out their own data centers, right? Well, I think that points to CoreWeave's strategic positioning in the AI market. They have a lot of high-profile partners. So they partner with OpenAI and Microsoft. Speaking of Microsoft, according to their S1 filing, which is an SEC filing that any company needs to submit before they go public on the market, it sort of airs their dirty laundry. They said that Microsoft now makes up 62% of their total revenue, which is up from 35% the year before. That's quite a bit of customer concentration risk. So when one customer accounts for over half your revenue, it's a bit scary because you really need to make sure you don't lose that customer, you don't make that customer angry, and ultimately that customer has a lot of negotiation power because they kind of own you at that point. And so Microsoft and CoreWeave have an interesting relationship here. It was rumored that Microsoft was actually pulling back on their services with CoreWeave. CoreWeave denied it. It was a whole back and forth, but it really points to customer concentration risk and why you might want to avoid that. If you think that's all the dirty laundry, you would be wrong. There's more. So CoreWeave operates a dual class share structure. And if you're not a finance nerd, that might sound a bit confusing. It basically means they have different classes of shares. So it's not uncommon, right? You might see Class A, Class B, Class C shares. Google is a great example of a company with a dual class share structure. You can buy GOOG or GOOGL. They're shares of the same company, but they have different voting rights. So CoreWeave has a dual class share structure so that their founders retain a majority of the voting rights without actually owning a majority of the shares. This article by Misfit Alpha on Substack says that as someone who wants to buy portions of businesses, I find these terms and corporate behavior revolting. So he's saying that it should be fair, that whoever owns the most shares gets the most voting power. Whereas this is perhaps unfair because the founders get the most voting power, even though they don't own the most shares necessarily. I see both sides of the argument. On one hand, it might be nice to let founders have more control of the company. Think Meta and Facebook with Mark Zuckerberg. They have something very similar. It kind of prevents a company from being taken over by activist investors. So yeah, I can see both sides of this argument. Oh, but wait, there's more. This other article on Substack claims that CoreWeave does not have a stable business. Essentially, this person who wrote this article is saying that CoreWeave is a young company and has already pivoted, so the history of their business is a bit unknown, a bit murky. They were founded in 2017, originally called Atlantic Crypto, a cryptocurrency mining operation that started by 3 guys that worked at a natural gas fund. When the crypto markets crashed in 2019, they renamed the company and bought up tens of thousands of GPUs. So on one hand, you could say that that's a strange pivot. On the other hand, it kind of makes a lot of sense. Both crypto mining and AI need a lot of compute power. So it makes sense that the company might pivot to whatever is going to make them the most money. And the fact that they bought up GPUs in 2019, right before the whole AI boom, was probably a smart move. However, it really does point out the maybe immaturity of this business and the fact that they really haven't been doing what they're doing very long. In fact, they hardly had any revenue just a couple years ago, and now they have nearly $3 billion in annualized revenue with a massive backlog. So perhaps I would take this one with a grain of salt. Finally, not only do they have a lot of debt, they are also spending through a lot of cash. They just made a large acquisition of a company called Weights and Biases, and it's reported that they spent $1.7 billion on this transaction. Interestingly enough, they only raised $1.5 billion in their IPO, so they've already spent the cash that they raised in their IPO on this acquisition. The acquisition kind of makes sense. It's a software company to complement their primarily hardware reselling business, and it's quite an interesting software company. Weights and Biases runs a platform known as MLOps, or Machine Learning Operations. It lets data scientists create new machine learning models and run them through workflows before they deploy them into production. This article says, as the demand for AI has grown, so too has the demand for MLOps platforms. So it makes sense that a company that's offering the infrastructure to train AI models would also offer the software components to train AI models, or to test AI models rather. So all in all, this is a very interesting company. I've seen people compare CoreWeave to WeWork. They're saying this is the next WeWork because when WeWork went public, as we know, they were kind of a massive sham. Their S1 filing also showed a lot of debt, right? So it's similar, but I don't think it's the next WeWork. In fact, I think CoreWeave is actually a very interesting company. It is difficult to value. It's a very highly leveraged company. I can see it being a very risky stock. However, you can't argue that they are growing like mad, and they are set up really well to take advantage of the growing demand for AI infrastructure. So for me, I'm totally not counting out CoreWeave, and I don't think it's the worst buy right now. I certainly wouldn't make CoreWeave a very large portion of my portfolio because there are definitely a lot of risks, but it's hard to ignore when the company scores so well on my spreadsheet, and when they were met with such a lackluster reception, it's kind of nice that you're not paying a super crazy valuation for this company. That's not to say that this company can't fall further. In fact, it very well could fall further, but I think at a price to annualized sales of 6.3, expectations by the market are not too high, and it makes a reasonable buy today, in my opinion. However, this is just my opinion. Nothing in this video should be taken as a recommendation to buy, sell, or avoid CoreWeave. It's really important to go out and do your own research on the company, but those are just my thoughts. What do you guys think about CoreWeave? Is this a stock that you're buying? Are you kind of waiting it out to see what happens? Are you totally not interested because of the debt and the Microsoft thing? Let me know in the comments below. And if you're new to my channel, please subscribe. I post stock analyses and deep dives on a regular basis. Thank you guys so much for watching the video, and I hope you have an amazing day.